Since the 2008 global financial crisis, global monetary policy has kept interest rates hovering near historic lows in an effort to stimulate economic growth. As a result of these policies, however, income-oriented investors have often struggled to find investments that can produce meaningful yield. Emerging market bonds are a rapidly growing segment of the global bond markets, in part because of the low interest rate environment. EM bonds typically offer higher yields compared to those from developed market governments and investment-grade corporates, making them an attractive option for income investors. EM bonds are issued by governments, quasi-government entities, and corporations from developing countries and can be issued in either hard currencies, like the US dollar, or in local currencies. For investors, the choice to invest in US dollar-denominated bonds versus local currency bonds comes down to risk exposures. US dollar bonds pay interest and principal in US dollars and therefore transfer the currency risk, which is a gain or loss due to changes in the value of the currency, from the bond buyer to the bond issuer. This feature can be particularly impactful for EM bond returns, given the volatility associated with many developing market currencies. EM debt issuance is split roughly evenly between sovereign and corporate issuances. Sovereign bonds are issued by government entities or quasi-government entities, such as wholly owned state enterprises. Corporate issuances, on the other hand, are offered by private enterprises. As in developed markets, sovereign EM bonds often carry higher credit ratings than corporates from the same country and therefore offer lower yields. EM corporate bonds can therefore help enhance yield potential and offer unique exposures from a variety of sectors and issuers. We believe an active approach to the EM bond market is an appropriate one. Bond markets are less liquid, and many EM bond indexes tend to overweight heavily indebted issuers. Monetary policy, currency fluctuations, and political risks are all factors to keep in mind when investing in EM debt. Experienced portfolio managers can help navigate the intricacies of this market and make nuanced decisions around country, credit, currency, duration, and risk exposures.